All right, well, thanks everybody for being here today and attending this talk, and special thanks to the organizers for putting my paper on the program. It's a really exciting opportunity. So my name is Constantin Charles, and I'm a PhD student at USC. And today I'm going to be talking about my paper, Memory and Trading, and just to briefly motivate the topic. So there's an increasing amount of evidence that past experiences are quite important for financial decisions. The one paper that really kicked this off is the paper by Malmendier and Nagel, in which they show that people who grew up during the Great Depression are much less likely to invest in the stock market later in life. And in a follow-up paper, they showed that the type of inflation someone experienced over the course of their life affects their beliefs about inflation later in life. Now, a compelling explanation for these strong experience effects are theories of human memory. So the constraints of human memory might have something to say about why these experience effects are so strong. And recently, economic theorists have started to incorporate human memory constraints into economic models. However, the evidence we have for those models is mainly from the experimental lab at this point. So that's really where my paper comes in. I'm going to try and bring those two literatures together. Specifically, I'm going to try and derive hypotheses from the memory models and then test those hypotheses with data from the field. And I'm going to be using the trades of retail and professional investors to conduct those tests. Now, to give you like a brief overview of what associative memory theory really is all about, I want to walk you through a simple example. So let's assume that Donald has to learn a list of words for a memory test. And the list of words is person, woman, man, camera, and TV. And Donald gets to practice that list 3 times. So he reads it again, person, woman, man, camera, and TV. And a 3rd time, person, woman, man, camera, and TV. And what you're going to notice is that it's much easier to recite that list from memory in order than, for example, in reverse order. And that already shows that the order in which we experience these words matters for how they're encoded in memory. Specifically for Donald, the words person and woman are going to be encoded quite strongly, or as the models call it, as very similar in memory, because they were experienced so close to each other on the word list. Now let's assume that Joe also has to conduct a memory test, and he also gets word lists. So his first list looks exactly like Donald's list, person, woman, man, camera, and TV, but his second list is a bit different. So the word shoe happens to slot between person and woman on that new list. And the 3rd time he practices the list, another word slots in between person and woman, namely the word picture. So these words slot right between person and woman, and that's how they interfere with the memory association of the words person and woman for Joe. So that really shows that associative memory theory is really about 2 competing forces. There's similarity and there's interference. So if we cue Donald with the word person and ask him, what's the first word that comes to your mind? He's most likely going to say woman. Whereas Joe, if we cued him with the word person, he might recall woman. After all, the 2 are associated in his memory, but he also might recall one of those interfering words, shoe or picture. So these word list effects that I just showed you briefly have been super robust for decades in the memory literature. And because they've been so robust, recently theorists have incorporated those insights into economic models. So 2 new theories are, for example, Bordalo, Giannaioli, and Schleifer from 2020, and Wachter and Kahana. And I'm going to take the tests that are implied by these models very seriously and test them, or I'm going to derive hypotheses and test these predictions in a high-stakes setting. So if we apply associative memory theory to trading, we can again assume that Donald has a portfolio statement that he gets shipped to himself from his brokerage account every month, showing him his stocks. And crucially, those stocks are listed in alphabetical order. So you can see that his stocks A, F, M, and S are exactly alphabetical, and the stocks A and F are probably associated in memory for him because they're right next to each other on the statement. So if he trades stock S and buys stock T, next month's statement will look like this, and again, stocks A and F are adjacent on the portfolio. And if he then sells stock M and buys stock Q, in next month's statement, again, stocks A and F are going to be adjacent on the portfolio. So therefore, the stocks A and F are going to be encoded as very similar in Donald's memory. Joe has the same brokerage and actually starts out with the same stocks. He also sells stock S, but he buys stock D. And because those portfolio statements are listed in alphabetical order, stock D slides in between stocks A and F on his statement. And then in the next month, he sells stock M and buys stock B. And again, that stock happens to slide right between stocks A and F. So for Joe, these stocks D and B interfere with the memory association between stocks A and F. So just as with the word list example that I gave you initially, memory is really shaped by similarity and interference. So if Donald trades stock A, that's going to trigger the recall of associated stocks from his memory, and he's most likely going to recall stock F, and he might then trade stock F. Whereas Joe, who also trades stock A, might recall stock F and trade stock F, but he might also recall stock B or stock D and then decide to trade stocks B or stocks D. And that's really the whole idea of the test that I'm going to be performing in this paper. So just as Donald and Joe, the retail investors in my data sample, receive monthly portfolio statements that list their stocks in alphabetical order. So I'm going to construct a very simple measure of similarity that just counts how many times two stocks, J and K, were associated next to each other on the statement in that month. And I'm going to do one more thing. I'm going to weight more recent occurrences a bit more strongly than more distant occurrences. And the intuition there is just that recent experiences are easier to recall than distant experiences. So intuitively, this measure of similarity just counts how many times two stocks were adjacent on the portfolio in the past 12 months. And using that measure of similarity, I'm going to construct the main measure that I'm going to be using, which is called memorability. And that really captures the memory strength of the association of stocks J and K in investor I's memory on day T. And again, it captures these two key ingredients, similarity and interference. Where here interference is just the total similarity of stock K in this example with all other stocks in the investor's memory. And with that measure in hand, I can already show you the main result of the paper in just two pictures. So what you see here on the y-axis is the probability of a memory-induced trade. So the idea here is conditional on trading stock K. What's the probability that the investor trades the memory-associated stock J on the same day? And on the x-axis, I just have memorability, which captures the memory strength of those two stocks. And as you can see, there's an increasing relationship, a positive relationship. So the stronger the memory association, the higher the probability of a memory-induced trade. Now, in terms of economic magnitude, if we go from 0 to 1 on the x-axis, that corresponds from going from no memory association to full memory association, you see an increase in the probability of a memory-induced trade by about 12 percentage points. Now, retail investors are great because I have data on the daily level for their trades, so I can really conduct precise tests. But the downside is that retail investors aren't quite as sophisticated and might be very prone to this type of memory-induced trading. And therefore, I'm going to also construct the same measures for mutual fund managers. And you can see the exact same pattern. So that's quite interesting because mutual fund managers are supposedly more sophisticated, yet they're just as prone to memory-induced trading as retail investors. One downside of using data on mutual fund managers is that I can't observe the trading data on a daily level, just on a quarterly level. So both data sets have pros and cons. The retail investors, I observe trades on a daily level, but they're not quite as sophisticated, while the mutual fund managers are more sophisticated, but I have more measurement error in capturing their trades. So to kind of go one step further, I'm going to run regressions of the following form. So I'm going to regress an indicator that's equal to 1 if conditional on trading stock K, the investor also trades the memory-associated stock J on the same day, and I'm going to regress that indicator on memorability. And again, memorability captures the strength of the memory association of those two stocks for that investor at that day. And in this regression, I'm going to be including stock pair fixed effects. So what these fixed effects allow me to do is to think of this regression in the following way. Essentially, I'm going to be fixing two stocks, J and K, and thereby holding their fundamentals fixed. And I'm only going to be varying the memory strength of those two stocks, both across and within investors. So the variation in estimating memorability here comes from two sources. On the one hand, the alphabetical rankings of stocks differ across investors because investors hold different stocks, Therefore, the same two stocks might be more associated in one investor's memory than in another investor's memory. At the same time, the rankings also differ across time, so the same investor might hold different stocks over time, and that way the memory association increases and decreases over time as the alphabetical rankings of the portfolio statements changes over time. So I'm going to be using both sources of variation in estimating beta here, but later I'm going to show you that I can really look at only one source of variation at a time, and I still observe strong memory effects. So when we look at the results of that regression, so as I mentioned, the dependent variable here is the probability of a memory-induced trade, and the independent variable is memorability, which captures the strength of the memory association. And in all columns, I have stock pair fixed effects that hold fixed two stocks, thereby holding the fundamentals fixed. In the second column, I'm also going to include day fixed effects. What these fixed effects do is they capture any event or any information that comes out on the trading day that might drive the decision to trade for all investors. And in the third column, I'm actually going to include investor times day fixed effects. So these fixed effects are super useful in addressing a lot of alternative stories. Because what these fixed effects do is they hold fixed any characteristic of the investor on that day that might drive the decision to trade those two stocks. Now that involves investor sophistication, that could also involve investor wealth, and portfolio size effects. All those things are soaked up by these investor times day fixed effects. Now what you'll notice is that across all columns, the coefficient is virtually identical and is very statistically significant. Now in terms of economic magnitude, what those coefficients mean is that if you increase the memory association from no association to full association, you get the probability of a memory-induced trade of about 13 percentage points. So that corresponds almost exactly to what we saw in the raw data, which again shows that the research design is pretty robust. And if you want to think of it another way, increasing memorability by one standard deviation increases the probability of a memory-induced trade by about 5 percentage points. So if we look at mutual funds, again, in all columns I include stock pair fixed effects to hold fixed the two stocks. But because I don't observe mutual fund data on the daily level, I can't include day fixed effects or fund times day fixed effects. Instead, I include quarter fixed effects and fund times quarter fixed effects. But again, across all columns, you see strong memory effects. And in terms of economic magnitude, they're actually quite similar to the ones of the retail investors. So increasing memorability by one standard deviation for mutual fund managers increases the probability of a memory-induced trade by about 6 percentage points. That compares to, for retail investors, it was about 5 percentage points. So they're very similar in economic magnitude. So just to recap, again, memorability really captures these two competing forces of similarity and interference. But by capturing them both in one variable, I can't really tell whether it's similarity that's driving the result or interference. And of course, the theory would predict that both similarity and interference are driving these results. So next, I'm going to include both those variables independently into the regression and see whether they have the expected loadings. So I'm going to expect a positive coefficient on similarity, which is intuitive, because as two stocks become more similar in memory, there should be a stronger memory effect. Whereas interference should have a negative coefficient, because as interference increases, the memory effect should fade away. And that's exactly what I find here. So you can see the coefficients on similarity are strong and positive, whereas the coefficients on interference are strong and negative. And the same result also obtains for mutual funds. So these results really show that it's associative memory theory that's driving these results, because that's a key prediction of memory theory, that you have the strong positive effect of similarity and a strong negative effect of interference. So to dive into the mechanism a little bit more, one of the strongest findings from the memory lab is that recent experiences are easier to recall than distant experiences. And I think that's very intuitive from introspection as well. Something that happened recently is just easier to recall than something that happened in the distant past. So what I'm going to try and do here is dive a bit deeper into the recency effect. Specifically, think of these three, let's look at these three statements here. This is the most recent statement. So stocks A and B should be associated pretty strongly in memory, whereas stocks A and F probably aren't as strongly associated in memory because they were experienced further in the past. And I'm trying to show that with an increasing transparency of these older statements. And in my tests, I indeed find those types of associations that were experienced further in the past have a much weaker effect than the types of experiences that were experienced recently. So these associations are much stronger than these ones here. So another classic prediction of memory theory is that of contiguity, which is that if two stocks were experienced very close to each other, they should share a stronger memory association. So again, the idea here is that stocks A and B, virtue of being so close to each other on the statement, should be more strongly associated than, let's say, A and M or A and S. And when I look at these types of associations, I find that the memory effect fades away, monotonically actually, with distance on the alphabetical statement. So again, that's a classic prediction of memory theory that's been shown multiple times, like endless times in the lab, and I also find that in the trading data. So one final thing that I want to go through is a bunch of robustness tests that help me address a few alternative explanations. So let's say that the investor actually isn't trading based on memory, but trading based on attention. So let's say when he trades, he looks at his most recent portfolio statement, sees stock A, decides to trade it, sees stock B, decides to trade that stock as well. Then that would be attention spillover and not necessarily memory. So what I'm going to look at is only at stocks that were adjacent at some point in the past and should therefore be encoded in memory, but that are not adjacent on the day of the trade, like those two stocks. So I'm really going to be honing in on those types of associations. And even for those, I find strong memory effects. So that helps me kind of sidestep this alternative explanation of attention spillover on the day of the trade. Now, I promised you that I was going to look into the different types of variation, so that's what I'm doing here. I'm going to include very tight fixed effects that are even tighter than the ones that I already have. To start, I'm going to include stock pair times day fixed effects. So what these fixed effects intuitively do is they control for any information on the trading day that pertains to both stocks. So if there's any information coming out that might be driving the trading decision, those fixed effects are going to capture that. And by doing that, I'm going to exploit only cross-sectional variation. So the only variation in the memory association is across investors now, because different investors have different rankings of the stocks. And I find strong memory effects. I also include stock pair times investor fixed effects. So what these fixed effects essentially do is they allow me to estimate the memory effect for the same investor for the same two stocks over time. So as two stocks become more or less associated for the same investor as his rankings change, that's the variation I'm going to be using to estimate the memory effect. And again, using only time series variation, I also find similar memory effects as before. So just to briefly conclude, in my tests, I find signature patterns of associative memory theory in the trading decisions of both retail investors and mutual fund managers. And that really validates the predictions from recent models that explicitly incorporate human memory constraints in economic settings. And that helps us shed light on the sources of these very strong experience effects that we've been seeing across many different settings. Now, before I close, I just want to raise the question, or the open question that remains is that whether this memory-induced trading might actually have aggregate effects. So are these trades important enough to actually matter in the aggregate? And I want to give you a brief preview of a paper that I recently finished writing in which I address this question, and I can answer the question with an affirmative yes. And just to show you that paper in two graphs, what I'm doing in that paper essentially is estimating aggregate memory associations. So I'm looking at which stocks are shared in memory by many investors at the same time. And having estimated those associations, I ask if a memory cue triggers the recall of one stock in the aggregate, does aggregate trading volume go up of that stock on that day? And what you see here on the horizontal axis is the strength of the cue on day T. So the stronger the memory cue for a stock is, the stronger the aggregate recall, and indeed, abnormal trading volume goes up really strongly by about 50 percentage points on that day. And that effect is so strong that it leads to temporary price pressure in that stock price. So here I'm plotting abnormal returns on the same day. And you can see that they're clearly positive. because a lot of investors then start buying that stock due to the abnormal trade volume that briefly pushes up the stock price. So these new results actually show that there are aggregate effects of memory, and that memory effects can be strong enough to influence pricing in financial markets. And since prices in financial markets are equilibrium outcomes, it really shows that memory effects can distort aggregate economic outcomes and provide an even stronger empirical justification for incorporating constraints of human memory into economic models. And with that, I want to thank you all for giving me the time, and thanks to Joey for discussing the paper. Thank you.